Every way to invest your first $1,000. Explained. High yield savings account. You have $1,000 sitting in cash, but instead of letting it do nothing, you place it in a high yield savings account that pays interest. The idea is simple. You earn money while keeping your cash accessible. Unlike stocks, the balance usually doesn't rise and fall with every market move. That makes this option useful for money you may need soon, especially emergency savings. But there is a trade-off. Lower risk and easy access usually mean lower growth than long-term investments. Interest rates can also change, so today's rate may not last forever. Think of it as a parking spot for your money, not a race car. Your $1,000 can earn some interest while staying available when an unexpected expense appears. The key benefit isn't explosive growth. It's keeping your money accessible and productive instead of completely idle. Certificates of deposit, CDs. A certificate of deposit works differently because you agree to leave your money for a specific period. You might choose 6 months, 1 year, or several years, and the bank pays you interest for keeping that $1,000 there. The attraction is predictability. With a fixed-rate CD, you know the rate ahead of time, but there's a catch. You usually can't withdraw the money early without facing a penalty. It's like putting your cash inside a safe with a timer. You know where it is, but getting it back early can cost you. CDs can make sense when you have money you won't need for a while and want predictable returns. They're less useful for emergencies because expenses don't care about your CD's maturity date. A CD can make your money work harder, but only if you're comfortable leaving it alone. U.S. Treasury bills. Instead of lending your $1,000 to a bank, you can lend it to the U.S. government through a Treasury bill or T-bill. These short-term government securities mature in 1 year or less. You typically buy one for less than its face value and receive the full amount when it matures. The difference is your return. For example, buying a T-bill for $980 and receiving $1,000 at maturity would produce a $20 return before applicable taxes and fees. T-bills are widely considered low risk because they're backed by the U.S. government. But safety has a trade-off. You aren't buying a potential rocket ship. You're choosing a defined timeline and relatively predictable outcome. For a first $1,000, T-bills can be an interesting middle ground between leaving money in cash and accepting the larger price swings of stocks. Broad Stock Market Index Fund. Your $1,000 doesn't have to choose one company. A broad stock market index fund can spread that money across hundreds or even thousands of companies through a single investment. Instead of guessing which business will become the next big winner, you're buying a small piece of a much larger group. Some companies will rise, others will struggle, and the market itself will move up and down. That's where time becomes important. Broad stock markets have historically rewarded investors who stayed invested for long periods, although past performance never guarantees future results. Dividends can also be reinvested, allowing your investment to potentially compound. The biggest advantage is simplicity. You don't need to constantly research individual companies or decide which stock deserves your next dollar. Your $1,000 is diversified from the beginning, making it easier to build a balanced portfolio. Individual stocks. Finding one company you believe will grow can be exciting, especially with $1,000. You research the business, buy shares, and become a small owner. If the company grows, your investment could rise significantly, but the opposite can happen just as quickly. A weak earnings report, new competitor, economic slowdown, or management mistake can send the stock lower. That's the big difference between one stock and a broad index fund. You have much less room for mistakes. Individual stocks can make sense if you enjoy researching businesses and can handle larger price swings, but putting your entire $1,000 into one company creates concentration risk. One bad decision can affect everything. The challenge isn't finding a promising stock, it's knowing whether the business can deliver and having patience when the market becomes unpredictable. Bond funds. Instead of buying one bond and waiting for it to mature, you can put your $1,000 into a bond fund that owns many different bonds. Your money joins a larger pool while the fund collects interest. This spreads your money across many borrowers. But bond funds aren't the same as savings accounts. Their prices can move, especially when interest rates change. When newer bonds offer higher rates, older bonds can become less attractive, pushing their market value lower. The benefit is balance. Bond funds can provide income and give a portfolio something that behaves differently from stocks. Think of them as a shock absorber rather than an engine. They may not offer the same growth potential as stocks, but they can reduce your dependence on one type of investment. That matters when markets get rough. Real estate investment trusts, REITs. Want exposure to real estate without saving hundreds of thousands of dollars for a house? A real estate investment trust, or REIT, offers another route. You buy shares in a company that owns or finances income-producing properties such as apartments, warehouses, or shopping centers. Instead of collecting rent yourself, you own a small piece of the operation. Some REITs distribute part of their income to shareholders, which can provide potential income. But share prices can still rise and fall, and REITs can be sensitive to interest rates and property conditions. Higher borrowing costs can pressure real estate businesses. Compared with buying a rental property, REITs require far less money and come without many landlord headaches. You don't fix the leaking toilet, but you also don't control the property. It's real estate exposure without taking on a giant mortgage. Investing in yourself. What if your $1,000 could increase your earning power instead of simply sitting inside an investment account? You could use it to learn a valuable skill, earn a certification, buy professional equipment, or build something that helps you find better paying work. The return can look very different from a stock investment. A stock might grow by a percentage, while a useful skill could potentially increase your income for years. For example, a skill that adds $200 to your monthly income could eventually recover the cost. But there is no guarantee. A course doesn't automatically create a better career, and expensive equipment doesn't automatically create customers. Results depend on the skill and what you do with it. You're not just trying to grow your money, you're trying to increase the earning power of the person controlling it.